Rick got up there and said, I sold 80% of my silver. I think crash is not a bad word for silver retreating from 120 to 70 bucks. Like, that is a move worthy of a cryptocurrency. My problem is that if we're in a period of correction and consolidation, which is my view, I don't think the market has topped. We saw a $100 drop in gold, right? Just in one day for no reason. $1,000 drop in a day in gold, I think would cause real panic, especially the people who are not fundamentalist holders. Failed silver squeeze a couple years ago. That was Rick Rule's buy signal. The peaks don't look the same. Like, a hypothetical peak now is not the same shape as the peaks we saw in the previous ones. I don't know which chip is going to win the chip war there, but they're all going to need copper and silver, and we're going to need the energy to power these things. History tells us everything gets whacked. We've seen this before. Even gold gets whacked, and people say, oh, gold is failing. It's supposed to be a safe haven. Why is gold getting whacked? No, gold is falling in response to a liquidity crunch because it meets that need. I'm not going to sell any gold or silver in advance of it happening because I might get that opportunity. No, I'm going to stay long.
Rick Rule trims physical silver. You are paying your mortgage at the current levels. I'm talking silver, of course. Are you a net buyer, seller, or sidelined on the monetary metals and gold, of course? And what price action would flip that stance?
I am sidelined. With gold plus or minus $5,000 an ounce, I'm not saying it can't go higher. I think, sure, 10 grand, no problem. I could see that happening. That doesn't mean it'll happen next, right? And you can't say that gold at 5,000 is a buy low opportunity. It is maybe an exciting buy high and hope to sell higher opportunity, but it's not a buy low opportunity. And silver all the more so. Silver at plus or minus 75, 80 bucks an ounce. That is, for mines that were built assuming sub $20 silver, that is a phenomenal level for the actual business. And you can see that in the better silver stocks. I think crash is not a bad word for silver retreating from 120 to 70 bucks. Like, that is a move worthy of a cryptocurrency, a massive waterfall event. Yeah. And yet the stocks, some of them drop maybe 10%, but the better ones maybe wiggled 5%. It wasn't that much. And they've hit all-time highs since. There are some that are at all-time highs at $75 silver that they didn't hit at $120 silver, because it takes Mr. Market a while to figure out, holy cow, these guys are like literally printing money with their minds. If you believe in hard money, they literally are, right?
Yeah.
When silver drops 40% and the stocks barely flinch, that's not weakness. That's margin expansion talking. As Lobo Tiggre points out here, the real story isn't the metal price headline. It's cost structure. Many primary silver miners were built around sub $20 assumptions. So at $75, they're generating extraordinary free cash flow, even after a crypto-style plunge from $120. A 10% equity dip on a 40% commodity correction suggests institutional investors are pricing in sustained profitability, not panic. The market is quietly signaling this isn't 2011's blow-off. It's operational leverage finally being recognized. And as Lobo Tiggre will imply next, the bigger question is whether valuation already reflects that windfall.
So it's not that I don't see the correction as a source of potential opportunity. It's just that I look at the stocks and I don't really see a screaming, compelling value. And yes, I understand that many of my esteemed peers are making the argument that if you price the stocks in the metals, which is more legitimate in monetary metals, because, gold and silver are money, than in other commodities, but it also makes sense because that's what they produce. So if you price the company in terms of a form of money that it produces, it makes sense to say that these things are actually undervalued. I don't disagree with that logic or analysis. My problem is that if we're in a period of correction and consolidation, which is my view, I don't think the market has topped. I think this is like, 3,000 or 2,000, right? We're sitting in that next period of consolidation. Well, if there's, the next time there's a big fluctuation, as you and I speak, just in recent days, we saw a $100 drop in gold, right? Just in one day for no reason, no good reason anyway. In that kind of market, the fact that these things are objectively undervalued in the true underlying real money and commodity won't stop those stocks from falling if there's a big scare. And
undervalued doesn't protect you when liquidity evaporates. As Lobo Tiggre stresses here, pricing miners in ounces instead of dollars may be intellectually sound, but markets trade on fear before fundamentals. A $100 single-day gold drop is roughly a 2% swing, and history shows that during consolidation phases like 2012 or 2020, correlations spike and even cheap assets fall together. If we're in a 2000-style digestion phase rather than a final peak, volatility will punish timing mistakes. Portfolio risk management matters more than theoretical undervaluation. And as Lobo Tiggre hints next, the real test comes when panic, not valuation, drives the tape.
What we've seen is that the stocks do retreat when the market retreats, regardless of the value proposition. And what I'm saying is, in a period of correction and consolidation, the little wiggles we've seen are nothing. Like a $1,000 drop in a day in gold, I think would cause real panic, especially the people who are not fundamentalist holders. But a $1,000 drop in gold would just be 20%. That's, I say just, but that's within the realm of correction and consolidation. That would not change the market, right? That would not be a fundamental shift. But the panic it would engender, it just makes it hard for me to deploy more cash now when that seems more likely than not. If you understand what I'm saying,
of course,
right. I'm not done with gold and silver. I'm very bullish on both. But do I want to put more money into something like this that seems likely to give me buying opportunities this year? No, not when I can see other things that look more legitimately like a buy low instead of a buy high and hope to sell higher opportunity.
No, I hear you, but give me some more color here. You call this a leverage flush, not a blow off top like 2011. So what specific signals would actually convince you to...
Right, yes.
A 20% drop feels catastrophic until you zoom out. As Lobo Tiggre makes clear, a $1,000 gold plunge sounds apocalyptic, but in percentage terms, it mirrors normal cyclical corrections we saw in 2006 and 2020. Panic sellers often confuse volatility with structural change, and funds forced to meet margin calls don't care about long-term thesis. The uncomfortable truth is that liquidity events punish even strong balance sheets temporarily. For investors, the difference between leverage flush and blow off top isn't price alone. It's sentiment collapse and volume spikes. And as Lobo Tiggre will clarify next, narrative shifts, not just charts, mark true regime changes.
So it wouldn't necessarily be price action. Narrative change, hate. Like remember the hate that silver suffered after the failed silver squeeze a couple years ago? That was Rick Rule's buy signal, right? Something like that, a shift in the market. People are still talking about gold, less so silver, but the monetary metals or the precious metals, that's not my term, but it's the popular one. They're still a buy. They're still part of the narrative on Wall Street. They're a hedge. They're an idea whose time has come, and that has not been shaken by this correction, which is really interesting. One more reason not to think that it's a blow off top, but to think that it is a period of correction and consolidation. I'll tell you another thing. Just in last weekend's free edition of the Digest, I posted some charts about the current, if this was the peak right now that we just saw in late January, how would that compare to the previous peaks in 2011 and 1980?
Yes.
And if you look at those charts, and this is for free on the website, you do have to register, but it is free.
Tops don't happen when everyone still believes the story. As Lobo Tiggre observes, real cycle peaks like 1980 and 2011 were followed by narrative exhaustion, not ongoing Wall Street endorsement. Today, gold is still framed as a hedge amid fiscal expansion and election year spending, hardly the nobody wants it phase that defines durable bottoms. Sentiment indicators in prior peaks showed retail frenzy and media saturation. We're not seeing that level of euphoria yet. Structural corrections look messy, but they don't erase bullish macro drivers overnight. And as Lobo Tiggre suggests, watch sentiment shifts, not just price spikes, for the real turning point.
The peaks don't look the same. Like a hypothetical peak now is not the same shape as the peaks we saw in the previous ones. I'm not a big TA, and I don't know how to describe this in cup and handle flag pennant terms or whatever that, whatever that is. I don't know. What I do know is I look at the chart, and this does not look like what happened before. It really looks like an uptrend with a big volatile spike, but that's still an uptrend that hasn't rolled over.
Yeah.
So seeing that change, Lucian, that would be something that would make me worry. If it really started rolling over and looking more, particularly like 2011, that would worry me, and we're not there yet.
Got it. If we get the stock market unwind, like you warned about in 2026, how do you expect correlations between equities, commodities, and the dollar to behave differently than in 2008 or 2020? And what's your playbook to stay long the right commodities while everything else bleeds?
Well, I'm not an economist. I get paid to kick rocks for a living. So I'm not sure I can really help you with that global macro kind of question.
Everyone's hunting for a 2011 style top, but the structure simply isn't there yet. As Lobo Tiggre notes, prior peaks in 1980 and 2011 showed rounded distribution and deteriorating momentum before the real breakdown began. Today's chart still reflects higher highs and higher lows, classic uptrend behavior, even after volatility spikes. That distinction matters because correlations during unwind phases, like 2008, tend to spike only after trend failure becomes obvious. For long-term investors, the risk isn't owning strength, it's misidentifying consolidation as collapse. And as Lobo Tiggre will suggest, the real stress test comes when cross-asset correlations start moving in sync.
Maybe Lynn Alden would be better to answer a big question like that. But let's just look at the commodity slice, which is where I'm going. So first and foremost, the order of magnitude of the kind of situation that you're talking about really matters. We're looking at some deflation of the AI bubble right now, like this SaaS apocalypse, as Bloomberg calls it. That's already happening right now, but it hasn't caused this huge panic. That if we had a waterfall event, right, a 2008 style scare, that would be very different. So as far as commodities go, even if there's a lot of angst about, who are going to be the AI winners and is it picks and shovels versus the app developers, and I don't know any of that, right? I can't tell you that. I can tell you that they still are going to need the data centers.
Yeah.
And, I don't know which chip is going to win the chip war there, but they're all going to need copper and silver, and we're going to need the energy to power these things. And it doesn't matter if some new DeepSeek comes along and makes them 100 times more efficient.
AI stock deflation doesn't equal commodity collapse. As Lobo Tiggre points out, even if SaaS multiples compress from 20x sales to 8x, which we've already seen in parts of tech, the physical build-out remains. Data centers still require copper wiring, silver in circuits, and massive energy inputs, regardless of which chip dominates earnings headlines. The 2008 style liquidity panic would hit everything temporarily, but structural demand for infrastructure metals doesn't disappear with sentiment shifts. Investors should separate narrative hype from supply chain reality. And as Lobo Tiggre implies, the magnitude of the unwind determines whether this is rotation or real contagion.
That doesn't mean we won't need the data centers. It just means we'll have 100 times more AI out of those data centers. So I think that if we look at an angsty, weak market in 2026, a lot of volatility broader, not just in the monetary metals, the AI hype goes down to a more rational and less exuberant level, I think that'd be a healthier thing for the broader markets. And I don't think it would change the narrative for the critical minerals needed at all. That would be actually a healthier, more bullish setting, I think, for those minerals, less prone to hypey spikes and more solid gains. I'd welcome that. But if somehow, some little tweak, we get to some critical level that triggers a bunch of stops and that triggers more stops and it turns into one of these, unstoppable waterfalls, That could happen as well. I can't tell you that it won't happen. And if that does, history tells us like everything, but everything gets whacked. We've seen this before. Even gold gets whacked. And people say, oh, gold is failing. It's supposed to be a safe haven. Why is gold getting whacked? No, gold is falling in response to a liquidity crunch because it meets that need.
Safe havens don't save you from margin calls. As Lobo Tiggre reminds us, during 2008 and March 2020, gold fell alongside equities because liquidity, not logic, ruled the tape. Correlations spiked toward 1.0 in true panic, meaning diversification temporarily fails when investors need cash fast. A rational reset in AI hype would actually strengthen the case for steady commodity demand. But a forced deleveraging event hits everything first. Long-term investors must prepare emotionally for short-term drawdowns. And as Lobo Tiggre will underline next, liquidity crunches often create the very opportunities patient capital waits for.
It is the ultimate source of insurance. If you need liquidity, right, you've got to have some cash. Well, you get what you sell what you can get a bid on. And that's gold doing its job. And we've seen this before. We saw it in 2008. Personally, 2020, my mentors tell me the same thing happens before. Like you get this immediate liquidity squeeze when the markets, go into panic mode. People sell their gold because they have to, they need to, and that's what it's for. And then there's a sharp recovery. The stock markets and the broader economy, who knows what how long that'll take. But monetary metals will come screeching back. And we've seen this before. So if that happens this year, I would expect the same thing. I don't know that will happen, so I'm not going to sell any gold or silver in advance of it happening because I might get that opportunity. No, I'm going to stay long, and if it happens, I'll be happy to buy more. And if not, and I think this is probably the more likely scenario, again, referencing Lynn Alden and her brilliant work on fiscal dominance, don't forget the money helicopters.
Liquidity events punish gold first, then reward patience. As Lobo Tiggre highlights, in March 2020, gold dropped nearly 12% in days, before rebounding over 30% within months once stimulus flooded markets. That pattern reflects fiscal dominance, governments stepping in before recession fully unfolds, especially around election cycles. Selling insurance during panic defeats its purpose. The recovery phase often outpaces broader equities. Strategic allocation means enduring volatility without abandoning thesis. And as Lobo Tiggre suggests, the real driver ahead may not be fear, but policy-driven liquidity returning faster than expected.
I do not think the powers that be will let a recession happen this year. And they won't wait for it to happen and then throw money at it. I think they're already throwing money at it. The weakness in the labor market, where, the whole Trumpification of the Fed, right? I mean, to me, this is fiscal dominance and that push to make sure, especially before the elections, right, nothing bad happens to upset voters. And that's inflationary. It's bullish for anything real that governments can't print, certainly including monetary metals. But I think, the other critical minerals as well, at least the ones facing structural supply constraint. I'm less bullish on like everything. Some of these things are still in oversupply, but things like uranium and copper are facing structural supply constraints. So those are my favorite of the critical minerals.
Recessions don't disappear. They get deferred with liquidity. As Lobo Tiggre suggests here, this smells like fiscal dominance, where policy bends to election cycles rather than economic reality. The labor market has softened for months, yet deficit spending remains above 6% of GDP. Historically, recession-level stimulus without a recession. That's inflationary by design, and it quietly redirects capital toward real assets governments can't print. Copper and uranium supply deficits are measurable. The IEA has warned about structural shortages. The real risk isn't recession. It's policy distortion, inflating select sectors while masking fragility. And as Lobo Tiggre implies, the next move depends on how long that political liquidity keeps flowing.
What's your worst case scenario for gold and silver?
For gold and silver specifically?
Yeah.
It's hard to think of one. I mean, the central banks aren't going to stop buying, not anytime soon. The debasement trade isn't going away, not anytime soon. The money printing, the fiscal dominance isn't going away. So it's hard for me to credit. But okay, so let's say though that let's go back 10 years, we were saying, gee, if the governments went crazy, there was war around the world, and they started money printing like crazy, gold might go to $5,000. That could be the worst case scenario, that this is happening. That, I look at what's going on now and I think, well, gee, it's got to go higher. The worst case scenario would be, no, gold has priced in what's happening now. Like we were right 10 years ago. We can't move the goalpost now. We said if it went to 5,000, that would mean shit was happening. Well, shit's happening now. It's priced in, and the next big move is down. Like this is it.
Sometimes the real risk isn't collapse, it's saturation. As Lobo Tiggre points out here, central bank buying hasn't slowed, with over 1,000 tons added in recent years, a structural bid under gold. But markets price forward expectations, not headlines. If $5,000 was once the crisis target, and we're there amid wars and deficits, then upside may already reflect that thesis. The Fed's balance sheet expansion and persistent fiscal deficits support metals, yet positioning data often peaks before sentiment shifts. The question becomes valuation versus narrative, not conviction versus fear. And as Lobo Tiggre cautions, if expectations are fully priced, momentum can reverse faster than believers expect.
That was the peak in January of 2026, and the next big move is down. And by the way, in 2011, there was the peak, and then there was a broad shoulder to the right. And gold didn't really go into a bear market until 2012, almost a year later. That's when things really went down, 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 and didn't come back.
I remember that.
For 4 more years almost. That's I think the worst case scenario right now for the monetary metals. But here's the interesting thing. If that's true, if that's where we are, that was the peak. It's 2011 all over again. Not my view. This is an if. If that's true, and if you were unfortunate enough to top tick 2011, you bought at $1,911 an ounce at the very top in September of 2011. Well, now you've more than doubled your money. Like if that was the worst decision of your life and you more than doubled okay, it took 15 years, but you actually came out whole, more than whole. Like you doubled your money. If you were right and you held the trade and you believed in the courage of your convictions, you would have doubled your money by now.
History doesn't repeat cleanly, but it rhymes in cycles of patience. As Lobo Tiggre notes here, 2011 peaked at 1911 before a 4-year bear market erased nearly 45% of gold's value. That kind of drawdown tests conviction, especially when opportunity cost compounds elsewhere. Yet long-term holders who endured eventually doubled their capital, proving time horizon matters more than entry perfection. The lesson isn't blind holding, it's understanding volatility as part of commodity cycles, particularly when Fed tightening follows stimulus waves like 2012. Risk isn't just price decline, it's emotional liquidation at the wrong time. And as Lobo Tiggre reminds us, endurance separates strategic investors from reactive traders.
And by the way, if you were that kind of person and you held and you believed in your convictions, you wouldn't have just top ticked it and sat there. You would have averaged down, right? And let's go conversely. If you bought at the bottom in late 2015, you 4x'd your money. Not foreign exchange, 4 times, right? So if 2011 is the worst case scenario that we're looking at now, it's not the end of the world for the patient, and it sets up the next round of opportunities. Like if you missed it, if you're new to this whole space and you missed the whole thing, the peak is in and you missed it, well, then 2011 is the best thing in the world for you, because that means another 2015 is coming. And if you know it now, like in 2011, nobody cared about gold for an entire generation. That's different now. So if you get another 2015 and you're prepared to take advantage of it, then that could set you up for life-changing financial gains.
Bear markets don't destroy wealth. They redistribute it to the prepared. As Lobo Tiggre highlights here, the 2015 bottom marked a near 45% decline from 2011 highs, and the rebound quadrupled capital for disciplined buyers. Averaging down isn't blind optimism. is capital allocation strategy when macro drivers remain intact. Today, awareness is far higher than in 2011, meaning sentiment cycles may compress, but volatility could intensify. The key question is liquidity timing, especially around Fed policy pivots and election cycles. Patience paired with cash reserves turns downturns into asymmetric setups.